Profile and asymmetry. So first up, what is asymmetry all about? Now, I'm sure many people have heard this word bandied around, and maybe this is not the perfect phraseology for it, but the way we kind of see asymmetry is when you're in a trade, there will be a point. There is a point where the probability of your trade working suddenly skews in your favor. Now, a situation, I talked about this yesterday, that when you get into a trade, a market ultimately is binary. It will go up or it will go down. But whilst you're in the trade, as the market moves towards target, there will be a moment. Maybe it's a movement beyond a price. Maybe it's a little piece of action. But where the market is trading can tell you so much about what the next leg of the move is. Essentially, once you pass this point of no return, once you pass into open space, the probability of your trade working jumps significantly. This is the moment where you can be very confident this is going to work. It's the moment where you can increase size on the trade. And we talked about this yesterday. By doing that, now you're in a situation where, yes, you can run this to target. You know that you're going to get paid on this trade. And this is something that you can establish beforehand. The asymmetry on a trade is not something that, suddenly comes along. You can see this coming. There's this potential coming up, and that's what you're looking for. So we're going to talk about this. I'll just get my water. It's always handy to get a sip of water as you are going through some of this stuff. So that's what we're going to go and have a little look at. Now, the way Profile does this is Profile allows you to understand what a market's been doing and therefore what potential it has in one direction or another. And I'll give you a real world example of this. Then we'll look at a more practical example in gold, particularly that trade that I talked about yesterday. We saw that one where gold just didn't really do anything yesterday. And that was the bit that you were kind of, excuse that, that's the squawk. That's the joy that you get on a trading floor. Let's just see if I can turn that one down for us. There we go. Turn the squawk off. That should solve the problems. Alternatively, it's going to get really loud, but we should be fine on that one. Right. So, real world example of your ability to be able to say, I don't think that move's going to be able to keep going, or I know where the market's going to move next. So let's go and have a little look at that first. And the way that I've always used a way of trying to describe how Profile helps you understand what's going on is by looking at things from the perspective of value and not simply price. I think a can of Coke is a reasonably good example of this. Everybody knows roughly how much a can of Coke costs wherever you live. UK, a can of Coke costs roughly somewhere between £1.30 and £1.60. Now, if you don't have a profile, all you're seeing is price change. And price doesn't tell you whether that movement is sustainable. So without value shift, you can't get price to sustain a movement. Therefore, you can very easily look at price and say, well, that's too high or that's too low. And this is relatively easy with a product that, we all know the price of. So to give us a little bit of an example, this would be the price movement of a can of Coke. You know that most shops you go into, you can pay somewhere in this zone, and you're happy to accept that that is decent value for a can of Coke. Let's assume you'll want to buy a can of Coke, that is. But assuming you want to buy a can of Coke, that's pretty decent value. Now, you will have situations where maybe a shop discounts their cans of Coke. They drop to 75p. In a real world situation, what happens very quickly, loads of people come and buy. They buy all of that Coke for 75p. Market goes straight back, i.e. shop stops selling it so cheaply. Maybe they were just doing a discount on it. Maybe they had stuff to get rid of, but the price will then very quickly move back. So where the asymmetry comes from is understanding that just because price has moved doesn't necessarily mean that that's where the market is going to go or keep on going. It allows you to look at it and say, do you know what? That's really cheap. This is a chance to buy. Likewise, on the upside, if you see a can of Coke for £2.50, unless you really want to buy that or you're really thirsty, you're not going to be paying £2.50. Therefore, you will get very, very few buyers up at these prices. What that then means is price won't stay there. Shops selling it for £2.50 quickly realize they can't do that, no one buys it, and they will move their price back down to where most people are happy to accept value. So that's a real world example. But what this is what you would call a one directional auction, a one way auction. You basically have price moving because either there's too many buyers and people realize they can sell it at a higher price, or there's not enough buyers and shops realize they're going to have to lower the price. So it's only a one sided auction. You have a buyer, customers, and you have sellers, shops, and that is it. But in markets, what you have is more dynamic price movement because you have two-way auctions. This is the whole concept of auction theory. So I'm not going to go into that in too much detail, but just to kind of get this understanding of, well, price cannot sustain movement. I'll explain this just a moment, yeah. Price without movement, price without the ability to shift value is not sustainable. How do you establish value? Value is basically established where the majority of trade happens, where the majority of volume is done. Now, the only way that price can move away from that and sustain movement away is if it is able to shift value. Let me give you an example. So what you've got here, and we'll move it through in sequence, so moving from left to right. If a market trades within a range, what you've got to think about here, remember, this is a two-way auction. So anybody who wants to buy and anybody who wants to sell will find it very easy to do so in this range. If you're a seller, there's many, many buyers. If you're a buyer, there's lots of people to sell. So therefore, this is an area where you can say value is established. Everybody is happy to trade in this same range, whether you're buyers or sellers. Now, when the market moves out of the range, this is the moment you have a question to answer. So what we're getting here then, on this move higher, for the market to shift value, yes, you get the initiative move. The market runs higher. But once that happens, what you need to see is buyers actually willing to trade at higher prices. If buyers don't come in and start paying higher prices, the market will just roll over very, very quickly. Because buyers then come in and are willing to pay higher prices, sellers now have people who are willing to buy from them, and the market can then trade. We can do a lot of volume in a certain area that shifts value higher. What that allows the market to do is continue the movement. But again, the same principle. If you move and don't shift value, market can't keep on going. So you look at a move like this would be a situation where market breaks out, fails to keep on going, and rolls straight back. It will trade in the same area of value. Again, that's where everyone's quite happy to accept value at this point in time. So hopefully that kind of gives you a little bit of a sense of it. But once value is established, now you have a situation where there are, for obvious reasons, a lot of people long and a lot of people short in the same area. You know, if people have all been willing to trade in the same zone, and think about this from a longer term perspective, it's not often the easiest when you're thinking about trading to get out of the mindset of being a day trader. You know, that's essentially what we all are. But you have to think about what the overall kind of situation is. When a market sits in an area of value, you're establishing bigger and bigger positions. Some people who think the market is going up are going to use that area to buy. Some people who think it's going to go down are going to use that area to sell. When you move away from value, now you have a situation, take this drop here. Now you would have a situation where anybody who is long has to get out. Anybody who is short in this range up here is now proven right, and they may want to sell more. Another profile feature, and something to, I'm not going to go into its huge detail, but a good thing to always remember is sort of a back of your mind rule of thumb. Markets moving into previous areas of established value will often trade straight the way through them, particularly when they've spent some time away. Because essentially, this was value is established higher. Anybody who's now selling is able to drive the market down here. If you thought this was value as a buyer, and then you thought it was value here, you're not going to keep on buying down here. Buyers get out of the way. So the market then rotates through value very, very easily when it has come from a distance away. Simple little rule to have in the back of your mind. Once the market drops, what then happens is, yes, you get sellers, but now once the price has moved down, buyers are now attracted again. Think of it like the can of Coke analogy. Price drops significantly. Are you willing to now buy it at these much lower prices? Yes. People then come in and buy, and this then establishes value at lower prices. So yeah, in very, very simple terms, yes, consolidation is ultimately where value is established from an auction theory perspective. So hopefully that gives you a little sense of it. If I bring this into a practical application, I think it becomes a little bit easier to understand. So let's get on to profile telling a story, because a lot of people just use profile and only look at yesterday's profile, or they only look at the current profile at this point in time. That's not telling you the whole story. The asymmetry that comes and that you can establish from profile often comes across multiple days. It comes from understanding the story of what's happened rather than just simply understanding the profile today. So let's go and have a little look at this in gold. So a couple of other little profile features. Remember, if this is an auction, what will happen is the market will trade down until it runs out of sellers and therefore will bounce back up, i.e. you run out of people willing to sell at lower prices and run back higher. This is what happens when value is established. If the market trades higher, you run out of buyers and the price gets pushed back down. So what we're seeing here then is after a period of consolidation, gold then rallies. And what helps you believe in the rally is that value shifts up. Now on these profiles, for those of you who haven't seen a profile before, what we've got is a time profile on the left, which is a sequence of letters. Each letter is a 30-minute period and overlaps the previous letter. So this is how it gets thicker and thinner at different points. The thicker the profile is implies that more 30-minute periods, because they stack on top of one another, have traded over the same area. So that's what's going on here. Then, as we move higher, more time is spent towards the top end. So what we're seeing then is value from a volume perspective. So this is the volume profile. So where the volume is traded on the day. So this shows you volume at price. What you're seeing here then is continued building out of volume at higher prices. And the value area is shown by the purple shading as opposed to the pink shading. So to answer Jan's question, I'm assuming you're probably going to get a few questions. I don't mind answering some sort of brief ones here. Volume profile, market profile, value, but you only know that afterwards. Too late. Good point. So let's get on to how you can expect value to shift and what exactly that's showing you. This is incidentally a full session chart. I will use full session for gold. I'll give you an S&P example in a moment where I will use regular trading hours session. Reason being, the S&P has a much more distinct regular trading hours. We'll get to that in a minute. Right. That's absolutely true, James. But once the price moves higher and value is established here, as low as possible for a buyer is now around about 1958, just down here. So this is now showing you that value shifted higher. The next day you get balance, value is maintained higher. And the following day we get more balance. So there's a lot of accumulation of time in the same area, a lot of volume in the same area. So the market is balanced up here. But what's significant about this is that when we trade down, you get a tail. Tails are significant because tails indicate a running out of sellers. Market is able to push back. So this is a good sign that the market is happy every time the price comes down. To James's point about buyers want to buy at the lowest prices, buyers come in and drive the market straight back up. This is what's called a buying tail. Same again the next day, price drops, push straight back up. The following day, we do push lower, but again, price drops, sent straight back up. Very, very thin tails. You do not have the same at the top. So what this is telling you is that the auction hasn't finished. Buyers essentially have not tried to push the market higher and found out if there are any sellers, or to look at it a different way, buyers have moved higher, they have come in to buy, and sellers have capped the market. So essentially, what's happening is sellers are, in a sense, artificially lowering the price. They're selling at a lower price than they potentially could get. So the assumption here is that the price can at least try and trade a little bit higher. And this is where the asymmetry comes in. Because what this is telling you now is that we know that there are buyers at lower prices. They're happy to come in here. But what we haven't seen is whether there are buyers at higher prices. And this would then be the point where you could complete the move towards the upside. So what we can now assume is that you have a lot of value established here. So think about this from the two sides. From a buyer's perspective, they're happy to buy up in this area. So roughly sort of 1965 down to 1959. Also, if the price drops away from this area, buyers are very quick to send it back. Sellers who are building short positions here are happy to sell, and they're also very easily stopping buyers towards the upside. This makes it quite easy to assume now that a lot of sellers are all going to be looking at this same area, 1968, as a point to place their stop. Where would you want your stop if you're short here? Well, just above the recent highs. So this can now say to you that, right, the next potential move is a break of the high. And it also tells you that if it does break the high, you've got a lot of positioning here that could get driven out. And as it does so, you could get a stop move, a quick breakout type move. The profile is basically saying to you that any move down, because buyers are quick to come back in, could well be a tricky move. You're going to move down and any sort of drop in gold is going to get sent back very easily. Any move up, though, once you get through the sellers that seem to be holding the market at the top, this should then become quite a clean and easy move. So what you can now have is a clear expectation of what's going to happen. You can also then structure what you want to do. You can make a very clear assumption that once you get above previous value, once you get above the previous day's value, so what I mean is this day's value. So this is the volume profile over the chart. That's the move up, and then here's the 3 days that follow. You can see the wicks on the candles, and it's always easy to say, well, you've got the wick on the candle, you should be buying it. But if you come in and buy it after this one, you get nothing. You come in and buy it after this one, you get nothing. And after this one, you only finally get something the next day. So it's about using the profile to say, right, well, now we're in a situation where this can move. Once you break away from value here, so you get above 1960, which is roughly the previous day's value. This is on an hourly time frame, an hourly candlestick. Once you get above value, your expectation is that we can break these highs. And if you break the highs, you already have a clear expectation that the market will then jump. So you can expect some stops to get triggered. So we've got now a plan. This is where the asymmetry comes in, because now you're very clearly skewed in one direction. You have a very clear conviction that if we do get up here, the probability of jumping over the level, because of the fact that we've traded it multiple times, is going up and up and up and up. So we're now in a situation where the probabilities of the breakout are getting skewed in your favor. Your job now is to try and find an entry onto this trade. That's the tricky part of the trade. We looked at this yesterday, the bit where the entry really didn't work. It did not give us the type of movement that we were looking for at all. What you then do get, however, is an entry that you would want to see. And if I bring you a chart up, a ladder up, I should hopefully be able to show you this. So give me one moment and I will get this. Right. Excuse me for a moment. It's always one of these. Whenever you do something live and you think you've got it nicely set up beforehand, it never quite works how you hope. And of course, it's not going to do it for me. Got all my times right. So if we don't have this, what I will do is I will record a video of it and I will post it straight on Telegram. So there you go. More reason to join on Telegram. Okay. I think what we might do is we might do it on Telegram, because what you don't want to do is watch me going, oh, let's try and set a chart up and let's try and set another chart up and it not, or another ladder up and it not come through. So we will rejoin that and I will send the video via Telegram. So get over to Telegram and I'll put the video up on there. But essentially we're looking for this stop type move. So your job then is to try and find a way of being long beforehand, because this is the point where the odds are now skewed very much to this jump through the highs. So do you mean you are going to hold the position overnight on that bigger move? No, I wouldn't be looking to hold the position, because I don't know down here that we're going to get this move. So when you get the move down the previous day, I'm looking at this thinking, right, if we can start trading above value the following day, remember the concept that well-traded value, we don't have to sit there any longer. So we're now trading through the previous day's value with the expectation this is going to jump. So the job then as a day trader, by understanding the story, is that if you can find a long in here, you have an expectation of a quick jump through the high. That's the bit that you're after. So that's the way that you're going to try and use your profile. It tells you what's coming next. It tells you what to expect. And so therefore you can use it to play that trade as the opportunity comes up. As I say, I will get a video of that. I'll put it on Telegram for you guys. So what happens next? Because it's all well and easy. And I think somebody mentioned this. Yes, absolutely, Lewis. Somebody mentioned this earlier, that it's very easy to see it after the fact. And so then the next stage of profile is, what should you do after this? So what I've got now is a shorter time frame chart. This is a 5-minute chart of just the move from as we come above the previous day's value up until the stops. So market then shifts higher. We get this steady shift higher. You're looking then to try and find an entry in here for the breakout. And this is where you then use your other tools, your candlesticks, your footprint, your price ladder. The profile's already told you what to expect next. So the stops go off. Now what do you do? Stops, as a rule, are a short-term end to a move. So at this point, the asymmetry's gone. The trade has played out. You've got exactly what you expected. But now you have to step back and say, okay, there's now no asymmetry. I don't know whether this is going to be the end of the move and we go down. I don't know if this is going to keep on going. So then you've got to think, well, what comes next? What's got to happen now for me to believe in a continuation of movement? What needs to happen then is either value shift higher or value reestablishes lower and we then continue to trade down in that same previous range. Are you the same firm as Futex, which was in London before they closed? No. Very quickly on that, I did trade at Futex. I was one of the traders there, but no, we are not the same firm. So what then comes next? Once value then shifts, now you've got another trade. Now the asymmetry returns. What happens after the stops move is you can see value then continues to build higher. So once value then builds higher, this little pink zone down here, you can now play the next leg of the move up. You can try and find an entry using those previous highs around 67.8. You can also play the breakout. You can play the pullback on the breakout, because now that you've established value higher, this is a much more sustainable move. It's a move that can continue towards the upside. So it's all about then using it is, but you have to take this from a day trader's perspective. I've read that book. I've read that book a couple of times. The problem with that is it explains the concepts, but what I don't think it does is it explains when you would use this as a day trading scenario. And that's the key to this. It's about having an expectation as the move progresses as to what can come next, where your asymmetry is. With this, once you establish value high, you know what's coming next. You can then try and play the book towards the upside. Yes, it is a book about profile. Precisely. That's always been my thing. I feel that's a very interesting book and it's worth reading, but it lacks the execution of it. It lacks the short-term trading principles. That trades from a much sort of wider type perspective and kind of defines things rather than makes practical trade application of it. Ultimately, as a day trader, your job is practical trade application. That's what we're going to get onto in just a moment. So you now see how the trade progresses. You're able to sort of hold back, and then you get the breakout. Right. Short-term asymmetry. This was what we were talking about in the S&P yesterday. And for those who were here yesterday, I was talking about the S&P and talking about the idea that whilst you're above 66, the S&P gives you the potential for a bigger move. I'm not going to come and answer every single idea, but the idea, or every single question, the idea of longer time frames, it gives you context. That's the whole point of profile. It gives you the context of what should come next. So what we saw this week is a lot of our traders didn't trade the S&P a great deal at all on Monday or Tuesday. But then we got activity yesterday. And the reason that you got activity yesterday is we went from a situation of lack of direction, lack of clarity, to a situation where the market direction became clear, where it became clear what was happening next. And this is what I was talking about. This is why I said 66 was so important yesterday, why I also then suggested 75 and 90 as my bigger targets. So what you're using profile to do is to be able to say, right, I've got a trade that I could play every day. For anybody who knows anything about the S&P, the initial balance on a regular trading hour session, so the initial balance is the first hour. On a regular trading hour session, the initial balance breaks, I think, about 98 or 99% of the time. So every day you will break the initial balance. But that's not useful information unless you've got context with which to use it. So what we're looking at here then is a situation in the S&P where you get unclear direction from the previous 2 days. So that's these 2 days here. Scrappy looking profiles. One opens and trades down, one opens and trades up. Values reasonably scrappy across both of them. This isn't telling you much. This isn't really saying there's much to be done. But what you can look at then is the way the S&P starts to trade the following day. This is on a 15-minute chart. Now, the S&P the following day, first 15 minutes, it opens, trades down towards the overnight low, trades down towards the previous day's value area low, and trades straight up. This is what you call an open drive. No, sorry, an open test drive. So you've got an open test drive. You've now got value shifting higher. So you see the progression of value on the day, this bit here. What you're now thinking is the probabilities are shifting very much in the favor of this being a trend day. Trend days are some of the hardest days to get onto. And I always try and point this out to anybody that I teach. Trend days are not as easy as you think. They're not the beautiful, explosive moves that you're looking for. That is a liquidation day. That has different characteristics, different skill set to trade. Trend days are different. But once the S&P gives you that clue, and that clue comes around here, the sort of high 50s, low 60s, that says, yes, look for a trend. You now know what to expect. What you're looking for is a break of the initial balance high, a break of the previous day's high. Once you get that, now you know what's on. Your expectation is you're going to have a profile that looks like this by the end of the day. This is why I was saying that 66 was so important. So once you get over the initial balance high, over the previous day's high, you expect a trend. Now it's just down to your execution. All you've got to do now is find an entry point around that 66 area. In this instance yesterday, as I said yesterday, it was dead easy. And so that is then where you get the continuation. If it is to be a trend day, one of the other rules on a trend is you will close very close to the high, which is exactly what you get. You get a market that trades straight up all day. You close very close to the high. By understanding profile, this is how you understand that this initial balance break trade is a good trade to take on the day yesterday, whereas the initial balance break trade on the previous days was not there. it didn't have the same level of value because of the fact that you didn't have a market that had this clear sort of breakout structure, this clear structure that enabled continuation. An open test drive is established within the initial balance. So it's the first hour. It can only happen within the first hour. But the first clue came in the first 15 minutes. So that was the S&P one. So I just wanted to kind of highlight what we were looking at yesterday and then the continuation of that. And the reason for my thinking on that was all profile based more so than anything else. So now we've seen a couple of examples. How can you use profile to find asymmetry? How can you use profile to know what's coming next and where the most likely direction of the day is? Now we're going to have a look at what's the day offered, the trade of the day. Trade of the day today was in the pound. Now, not a market that necessarily we always talk about. I know that we often talk about S&P, we often talk about bonds, gold, things like that. But the pound was the one today, and a lot of our traders knew this. The reason being that you had fantastic structure for a move. And this is what's really important. It's about understanding the structure and the value that you have in any kind of trade. So there's the opportunity. This is where all the money was made. This is a 5 minute of the P&L on the day. And as I was talking about yesterday, it's about home runs and capital preservation. You got that today. Home run early on, capital preservation. We did get a loss in here as well. So some people lost a bit of money playing the Bund continuation trade, which didn't actually work out. No, initial balance is always the first hour of trade. So what we've got then is scope of movement. The reason why this trade in the pound was so valuable was because the scope that was offered and the way that you could tell this was from profile. So let's go and have a little look at what exactly happens, or the way to try and think about this. What you have to remember is markets move from balanced to imbalanced. So the way to think about this, balanced market positions get built up. Then you will get a trigger. The trigger is either a technical structure or it's a fundamental thing. I'm going to discuss correlations tomorrow. So it's either a technical or a fundamental trigger. Once the trigger happens, you then get imbalance. The imbalance is an unwinding of positions. This is what creates the prolonged quick move. Then you get balance. This is the establishment of new positioning and the potential to continue movement. So let's go and have a little look at what exactly we had. Prior to the number then, this is what you had in the pound. So what we've got then is pound profiles, daily profiles on the left. This is full session. Again, there is no regular trading hours session in currency. Full session. And then what I've also got is a 60-minute chart with the profile over the course of the last 2 weeks. What we've seen in the pound over the last 2 weeks is a trend week followed by a balance week. That makes sense. Imbalance to balance. The market is imbalanced here and then we balance out. But unlike the gold situation, the pound did not have tails to the downside. So the pound is not suggesting that buyers are very quick to push it back up when it pulls back. So now you have a situation where this is not a market that is looking so strong. It does, however, with a balanced situation, have the potential to move either way. Either we move higher above 31.43 or lower below, 130.54. So the break of either of those gives a potential move. What you're also looking at then is what's going on with your profiles. The profiles are showing you that the market is very balanced up here. Classic little thing to see on a profile: no value, builds value, builds value. You've got the same thing down here, lack of value down here. We could end up trading in this zone down here, and I'll show you exactly what happens in just a moment. So what you've got is a balanced market. This has got potential to move in either direction. So the trigger that comes from the UK CPI number this morning is what is going to enable a movement. It doesn't mean you have to be the fastest finger on the data. What it means is that once that data comes out, if it triggers a further move, you can understand the scope of this. Is it realistic on the back of all of this positioning to come down and fill this cave? Yes. Is it realistic to get down to this VPOC? Yes. Previous VPOCs, unlike a cave where you can get stuck, a VPOC you can trade through quickly. So you can see how there is a very, very large scope in the pound for the rest of the day. So let's go and have a look at what this then means for the way that you take this trade on. This is the move that you then get. So this is on a 5 minute now. Now remember, you've got this little cave down here. This potentially could be the area we get stuck between around about 129.97 and 129.67. That's the area that we could potentially get stuck. So the market drops very quick on the UK GDP. Instead of sitting in the cave though, that's where it's marked off there. So 97 down to around about 67, trades straight the way through it. This is a very, very good indication of the willingness of this market to go lower. But what you have to remember, that sequence, this is an initial unwind. Anybody who was long at the top gets driven out. Yes, there are some new sellers in this, but for the market to keep on going, it has got to establish value at lower prices. And until it can do that, it cannot keep on the move going. And this is where understanding profile explains to you the scope of what more can happen. It's a very easy one to look at and go, okay, great. In the moment, you look at this, go, right, quick move down. If you've sold it, the market drops, then it stalls, you get out and everyone goes, oh, I don't know what to do next. But the profile is saying to you, you've got all of this positioning that perhaps hasn't fully unwound. You've got these areas to the downside that need trade around them. Or if you can't establish trade in here, this is an even bigger sign of weakness to the downside. This is on the left-hand side, a daily profile. So now what we have is a situation where you trade straight through that cave. That's a great sign of weakness. So for anybody wanting to play a continuation trade, and this is why you don't need to necessarily always be looking to trade data, but it's what the data triggers, which is the bit that you're interested in. In this example, you're looking at the pound against the dollar. So we can't look at individual underlying assets. You're looking at the pound versus the dollar. With stocks, not necessarily, no. So what's happened here then? You get the pullback. What we're interested in then is how do you get onto this trade? How do you play this trade? And so what's happened now? The profile's told you what to expect next. So the asymmetry in the market is there. Value starts to establish lower. Now you're very, very confident of continuation. The pound, incidentally, now is trading around about 28.93. So we've gone and continued this through this area of low volume and kept this move going on. The time frame on the right is 5 minutes. So what we're looking at from this is, right, how do you get into this reversal trade? So you're now looking at this, get onto your short time frame charts. What is it that's going to let you into this trade? The profile's done its work now. You know what to expect and you know what to do. You want to be short. You've just got to find the short. This is where we then go back to the tools that we were talking about earlier on in the week. How do you sell this pullback? The easy way of looking at this is a 1 minute chart. You get this quick pullback and that pulls back to 29.82. How do you sell this then if the market doesn't get back to the level? That's where the difficulty comes in. So you've had that quick move down. I'll bring the ladder in and we'll go and have a little look at what exactly you are seeing on this. So this then is the pound, and I'm going to make a strong assumption that this time it will work for me because I tested this earlier and it worked very nicely. So this then is the first bit of movement. So we'll go and have a quick look at this. But the difficulty of trading any kind of data, of course, is that once you get that first movement, and this is where I would always clear the volume profile on the ladder. It's not fully cleared it. Once you get this first bit of movement, then you're looking for a pullback. So it's not about, this isn't about trying to trade data. The first move absolutely does come from CPI. But once the CPI comes lower than expected, you now know what to do. There you go, quick drop. So market trades to around about 20s, keeps on going down, keeps on driving lower. keeps on driving down. Very, very thin. And I appreciate a lot of people like to trade in situations like this where it's so volatile. So you're now looking at, right, well, what happens? We bounce back towards 97, 98. This is the bit where you've got to be very, very quick if you want to be part of this. But after this, once we start to establish trade at lower and lower prices, you now understand that this market has got the scope to keep on going. So then you're looking at, well, how do you get in later on? How do you play this? And this is the second wave trade. This is a structured trade. This is based on the profile. So how do you get into this trade? Because at this point in time, very, very difficult to be able to get into this and be able to hold on to this. The way that you take it on here, use the volume profile very short term and try and sell that 82, 83. That would be the point that you use as resistance, and you place your stops around about 92 on this. So that's how you would enter this on a very, very short term basis. But once that's happened, how do you get into this later on? Let's say you don't like trading data, you don't like that volatility. Well, to get into this later on, you now need to get back onto your candlesticks, onto your footprint. Candlesticks has told you potentially the area to sell, which is 82. Now, if you don't get the chance to do that, what do you do next? So we've missed the chance just there, and I'll stop you just there. This is now where a profile comes into play, because what I say a profile, a footprint comes into play. In that initial move, this is where footprint is really, really valuable, because in that initial move, what you've got is a fast move down, and then look where you see the volume come in. Comes in at 76, trades through a large order there. Yes, we see a few larger bids traded through earlier on, but even when it bounces back, again, more trade at that 76 area. So rather than just looking at 82, then you can look at 76 up to 82. You could sell 76 and have your stop above 82, because that's the high of the pullback on a candlestick. And now the footprint is telling you that, but actually what happened within the candlesticks is a little bit more accurate to 76. That's the area that now you want to try and trade. So let's get this one back up and I'll show you exactly what's going to happen. Now, you're not looking for this necessarily to be the fastest moving action as you come back towards that area. You're just looking at the pound as you come back towards 76. You can get your orders in, waiting then for the market to trade up towards that 76 zone. That's all you're looking for. You know that you can have your stop placed above 82, and you can be quite happy now to sort of sit here. You enter this passively. You know where the action's taken place before. You know that any selling that was any buying that was attempted at 75, 76 area very quickly gets whacked straight the way back down. So you can be quite comfortable here. Get your bids, get your offers in. If you trade back up here, wonderful, you can sell this. And you don't need to see a great deal on the ladder. On the ladder, what you're looking for is an absence of buying. As long as you don't get any buying here, you're absolutely fine on this. You can be quite confident to sit there, wait for your fills, and then, because the profile suggested that you've got that wider structure to the downside, you're now looking at this thinking, well, I've got myself a nice stop of 10 ticks, and you're looking potentially now through the lows all the way down towards 2,900 and potentially beyond there. So you're now in a situation, you can see the P&L, you're up to around about 2,500 and you're risking around about $300 on it. And the reason that you've got that is because the profile is showing you that there is so much scope for that additional movement. On other days, you won't have that scope. The market's never going to put that size of move in because you're moving away from value and you don't have all of that space towards the downside. What you've got here is well-established value, shift away from it. As long as value starts to build below that 76 to 82 area, this is going. Quick answer to that. Do institutional traders use footprint charts? No, I don't believe they do. Any trader trading in a bank is not using a footprint chart. When you're talking institutional, that's the type of people you're talking about. You know, we're day traders. We're short time frame traders. They're not using a footprint. What you've got to think about there, traders at banks are generally executing client orders. So they essentially put the business through. But if a client says, buy the pound at 29.70, they're going to come and buy the pound at 29.70. They don't care about the footprint. Essentially, the flow that you get from more institutional traders is the flow that creates the footprint, that creates the movement that you're seeing. They don't use it. We're the people who use it, because what it does is it enables you to understand the flow of action on the day. But institutional traders aren't using it. So anything you hear along those lines, I would suggest is coming from someone who's trying to portray the idea of what institutional traders do, when actually they're looking at it from a pure day trader's perspective. So there you go. That's my view on that. Could I elaborate? Yes, on what I mean by this. So I perhaps abbreviated this a little bit too much. Right. So you've got a couple of larger orders here. So these are large buy orders that get traded straight the way through. When the market trades above them, this would theoretically be the point where the buyer's strength comes back in. You trade above the large order. That theoretically means that the market is not willing now to trade lower. When you trade up there, though, look how little is done. Very, very light footprint. Market's not willing to trade up at these prices. So when it does that, this tells you that, yes, there was somebody willing to buy there, but there are no more buyers when you get up there. So this is the bit that says, yep, you can be confident to try and sell this once more. And that then establishes this whole situation of 76 up to 82. 82 was traded in a flick. 76 was traded, and then the market was still able to trade lower from it. Therefore, 76 is the level you're interested in. That's why you want to be short there. So there we go. That's given you a little bit of a sense of how to use profile to find asymmetry, and then you scale down the tools. You use your execution tools, your candlesticks, your footprints to define exactly where you want to be in. You then use your price ladder to tell you exactly how to get in. This very much a passive trade that you're trying to get onto. Very simple. Let the market trade up, put your offers in, build, stop at 85. You can let this one go for the rest of the day. On that note, I will wrap it up there. I am going to be live final session for you guys tomorrow. I'll answer that quick one on that one, Michael. So what we're going to look at is, well, how do you apply all of this together? I talked about correlation before as well. We're going to talk a little bit more about different types of correlation tomorrow and how to use those across different asset classes, not just intra-asset class. The point there, Michael, on the price action would chase you out of a short. Don't think about it like that. Is there anything that's telling you buy? Flip your situation over. If you're short, is there anything that's really saying this is going up? And I got to argue, from the profile, from the footprint, from the candlesticks, nothing says this is going up. Yes, the market is not dropping quickly, but that doesn't mean it won't go down. It just means it's not doing it right now. You're right in that situation. If you give up then, you've just given up the greatest potential trade of the day. That's why you don't give those situations up. You know where your stop is. Don't get out until you get stopped. Right. I will leave you there, though. Final reminder, 4 p.m., same time, same place tomorrow. I will see you all then. And I will, if people are willing or want to, I will very quickly run up to the trading floor. So what I'll do, I'll turn my camera off. I'll meet you outside and we'll give you a quick walk up. I'll walk up back up to my desk. You'll be able to see where I sit, see the way that I have my desk set up as well. So I will see you guys tomorrow. I will also see you guys in a few moments just out there, and we'll go for a quick walk up through the floors. Catch you in just a moment.
So I will see if I can switch the other things off. There we go. Right. Hopefully you guys can see me full screen. So just walking up the stairs. So we're walking up from where we were. I'll be able to talk you through what the rest of the office looks like. So you've got back down there, kitchen, nice little balcony area, but we want to see trading floor. So let's get going all the way up the stairs. And it's a long run up the stairs. I'll spin the camera around for you if possible. And you can see then, first floor, trading floor. A few guys are still in the office in there, but I'll run you all the way up to my floor, which is a little bit of a walk. We're up on the third floor. We've got 3 trading floors on the go at this point in time. So we're up on the third floor. I'll keep on moving, keeps you fit at least. So here we go, onto my trading floor. Hopefully there's a few of the guys left. Yeah, there's a few people left. I can see myself on a screen. Hey guys, now you can see yourselves.
Hi everyone.
So there we go, up onto the trading floor. Right, this is where I sit. So sit over in the corner. Hopefully you guys should now be able to see my whole screen. I'll see if I can spin the camera around. If not, there we go. So this is how I have everything set up. We have ladders, big screen across the bottom. Then we have charts all the way up at the top. And then a little bit of internet, so you've got any information coming in. So there you go. That is how you have it set up a trading desk. That also is where I sit. Tired after running all the way up the stairs. So I'll leave you there, guys. Have a wonderful rest of your day. I'll see you all 4 p.m. tomorrow. Catch you then. Come and join.